Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing the company Qorvo, ticker symbol of QRVO, and honestly, this is the second time that I've analyzed this company. It's been a while though since I've analyzed it. This was actually brought up by Savvy Gamer, where he pretty much just said, hey, love your analysis. Can you make an analysis on Qorvo? Thanks. This is 8 days ago. I'm just getting to it. Guys, there's a lot of people asking for recommendations, so please bear with me if you have asked for something and I have not gotten to it yet. I will get to it eventually, but for now guys, we're going to be analyzing Qorvo as a recommendation by Savvy Gamer. And it's actually analyzed this company because last time I actually analyzed it, it actually came out to be like a very, very good buy. And well, I'm going to show you guys the graph on this, and well, it's actually very, very interesting. So with that said, let's get started with this analysis. So we're going to come here guys to the graph. Now as you can see on the 1 year, it is down 49.54%. On the year to date, it is down 46.17%. Guys, look at this 52-week range. $83.91 was the low and $178.50 was the highest, which is just insane. Last time I actually analyzed this, I believe it was at 125. So guys, current share price $85.82. This is at 52-week lows. This might actually present itself to be a great buy, if assuming, of course, the fundamentals actually make sense. And of course, if the current share price makes sense with future analysis. So bear with me on that one, right? We'll analyze the fundamentals in just 1 second. But guys, 52-week low company, this is looking like a really good opportunity right now. So with that said guys, let's come over here now to the calculator. We got the ticker symbol of QRVO, market cap of almost $9 billion with a PE of, look at this, 11.61. That is actually really good. I like to buy companies that are under 20. And again, the current share price is only $85.82. Last time I did this, it was $125. So if you guys remember that video, and I think I said it was a good buy back then, this actually might be a very good buy today. Obviously, the calculator has changed a lot. I've added a couple of stuff, so we'll do it with this new one and see what we get. But just from the last time, it may actually be even better buy today, which is crazy. Now, they do not pay out the dividend, which, okay, all dividend investors out there are like, nope, skip, done, I'm out. Guys, just because a company doesn't pay out the dividend doesn't mean that they're not giving you value in other ways, i.e. share buybacks or just increase in cash flow. So just because a company doesn't pay the dividend, don't take it out of the running. It still has a lot of possibility to be a great company for the future. Now, because they don't pay out a dividend, this means that all of their cash flow is going straight into themselves. And as you can see right here, their cash flow isn't that big. It's only in the millions of dollars. But we also want to take a look at the growth of the cash flow as well, because if a company has like several billion dollars in cash flow, but it's remaining stagnant, it's not as good as if it has millions of dollars and it's increasing consistently. So with that, let's actually take a look at the fundamentals, starting of course with the net income 5 years ago of negative $40.3 million. That's kind of concerning. However, guys, 1 year ago, they were at $1 billion, increase of 2,664%. Now, looking at this graph, you're probably like, that is an insane amount. Oh my God, there has to be outliers. Well, you know what? Aside from this negative net income 5 years ago, guys, this graph looks amazing. Honestly, it really does. There are a couple of problems here, like for example, 3 years ago to 2 years ago, it was a little bit of an outlier, right? It wasn't consistently, there was a big gap right here, but you can see that there are no really big outliers, right? It's not like you have 1 year massive and then it crashes the following year. Nothing like that. It's all fairly consistent. So you know what? This is actually not that bad. Now, because they do have a negative value for 5 years ago and we do see a massive jump, I'm not going to give it 100%, but I'm going to give it a fairly decent score of like 80%. Now looking at the free cash flow, the most important of all the profit metrics, this is the one, guys, that companies use to essentially do everything. Pay out the dividend, which they don't, but still they could pay out the dividend if they choose to in the future. Buy back shares, which is another way the company could bring more value to you just by increasing your ownership of the shares that you already have. pay down their debts, which makes them more solvent in the future, and make acquisitions to just grow the company as a whole. So very, very important, guys. Now, we do see something very interesting. 5 years ago of $582.7 million to 1 year ago of $835.7 million. That is an increase of 43% with an average of $780.86 million. Now, this graph actually is kind of interesting, right? From 5 to 3 years ago, well, technically from 5 to 2 years ago, it was increasing. We do see a massive jump from 3 to 2 years ago. The 2 year ago one of 1.1 billion is probably due to because of COVID. So that might be the reason why their capital expenditures probably went down and their cash from operations either remained the same or went up. So because of that, I think that's the reason why this occurred. Guys, they operate in like the wireless technology kind of service. So that makes sense as to why during COVID they did $1.1 billion, right? It makes sense. And probably the reason why they went down 1 year ago is because they came back down to earth, right? They just came back down to earth. So even with that, we can see that essentially from 3 years ago to 1 year ago, it was still an increase, assuming that we take away the 2 year ago value. So for that reason, guys, because this is an outlier, I tend to ignore outliers when during COVID. If it is down, guess what? I'm going to do the same when it is up like that as well. So for that reason, guys, it's actually looking fairly good. And because there wasn't really much of an increase from 5 to 4 years ago, I'm not going to give it a perfect score, but I will give it like at 90% or so. Looking now at the revenue, we got 5 years ago of almost $3 billion to 1 year ago of $4.6 billion, increase of 56.24%. Now looking at this graph, we can see that, well, we did have pretty good consistent growth, a little bit of growth, right? Not a lot, but still a little bit, but consistent growth from 5 to 3 years ago. Pretty big jump from 3 to 2 years ago, probably because of, again, COVID. And then this actually persisted into 1 year ago. Now, because of this massive jump right here from 3 to 2 years ago, I'm not going to give it, guys, a perfect score, but it is still a really good looking graph, honestly. So for that reason, I'm going to give it like a 95%. Looking now at the assets and liabilities. If we take the assets and subtract the liabilities, we get to see if the company is able to survive a downturn. Obviously, if they have more assets than liabilities, this is a good thing. And if they have more liabilities than assets, that's a really bad thing. Currently, they're at $4.3 billion. And looking at this graph, it actually is kind of stagnant. The trend is kind of leaning downward, but as you can see, it's mainly just stagnant overall. Now this year's is by far one of the lowest, right, in comparison to that of like 4 years ago and 3 years ago. But this year, guys, is not over yet, so they might actually still surpass the 1 year ago value of $4.5 billion. Average assets around $6.8 billion. Average liabilities is $2.3 billion. Doing this difference, we get $4.5 billion. And I'm going to give this, guys, not the best score, but not the worst score either. I'm going to go with like a 60%. Now, this is the graph that we didn't have when we first did this company, doing the cash flow minus the liabilities. Essentially what we just did with the assets, but now instead of assets, we do the cash flow. Because remember, cash flow, it is what companies use to pay down their debts. So looking at this graph, guys, we see that the cash flow was consistently increasing. However, when it came to the assets and liabilities, we could see that it was remaining somewhat stagnant. And this actually tells us a little bit more of that story when it comes to the liabilities, that they have been getting a whole lot of liabilities, because even though the cash flow is increasing, this is just heading down towards the ground hard. Now, there are some instances here where they did slightly go up, right, from 5 to 4 years ago, and a little bit of an increase here from 3 to 2 years ago. But guys, as of last year, they're at negative $2.12 billion. That's not good. This is by far like one of the worst graphs so far that I have seen when it comes to them, but they do have instances of where they're trying to grow this back. Average cash flow minus the average liabilities, we get $1.4 billion. I'm going to give this guy by far the worst grade so far, and I'm going to go with like a 40%. Looking now at the most underrated of all the metrics, it is the shares outstanding. Guys, this metric, I can't stand to tell you how important it is for this thing to be going down. And normally companies that don't pay out a dividend and that aren't like mega caps tend to issue shares, because when they issue shares, especially when their share price is really high, they are getting that cash back, right? They're essentially diluting us, the people who hold the shares, but at the same time, they're using that cash to essentially pay down their debts and make acquisitions, do all that stuff. It's just another way for the company to pay for doing stuff instead of just their cash flow. That is actually fairly surprising, because companies that don't pay out a dividend tend to issue a ton of shares. However, this is actually a diamond in the rough right here. 5 years ago of 126.3 million shares to today of 103.3 million shares. That is a massive decrease of 18.21% on the 5-year, and from the previous year to the current year is actually also pretty decent at 2.82%. 1 year ago of 106.3 million to today of again 103.3 million. Guys, this graph looks amazing. Every single year they have bought back. There hasn't been a single year where they have issued, which is just simply amazing. So if they continue to do this, I'm afraid that there won't be any shares left to buy back. But this is looking really good, guys. I'm gonna give this essentially like a 100%. This does not get any better than this. Now looking at the cash and equivalents, they currently hold $858.8 million with an average of $930.2 million. So let's do a quick overview, guys, on their fundamentals. We got the net income 80%, free cash flow 90%, revenue 95%, assets minus liabilities 60%, cash flow minus liabilities 40%, and the shares outstanding of 100%. With all of that, guys, we get a total grade of 83%. Now the main issue here that I see is mainly the liabilities, but there is a silver lining to all of this. Their main concern with that cash flow is to buy back shares. They could easily just be like, no more buying back shares, or let's just reduce the share buyback and start paying down these liabilities, start paying down these debts, which would essentially make these numbers a whole lot better in the next upcoming years. But even with that, they're still at an 83% for my personal grade, guys. This is looking amazing. So with all of that said, let's figure out if $85.82 it is a good buy right now. Looking at the revenue growth, predicted share buyback, and required rate of return for 3 assumptions, low, medium, high, let's actually make some assumptions here. Now, before we even get started with this, guys, take a look at this base price already, $155, not adjusting for debt. This will only go up, right? Any positive revenue growth assumption and predicted share buyback is going to make this thing go up. So be ready for the numbers that you're about to see. So let's come over here to Seeking Alpha. Revenue growth forward is 4.42. Revenue growth year over year is 5.36. So let's be conservative when it comes to this, guys, because I want to take into account any and all possible situations. Interest rates are going up. When interest rates go up, it gets a lot harder. Remember, this is a tech company. Tech companies follow interest rates pretty well. They are essentially subservient to how easy it is for money to be borrowed. The harder money it is to be borrowed, they're not going to grow as much. So we're going to take that into account. So for the low assumption, let's just say a revenue growth of like 2%. For the median assumption, let's go with 3%. And for the high one, let's just go with 4%. Now, if you guys take a look at my previous video, I think I had this in like the 18%. Well, guys, things have changed. Like, obviously, like things have massively changed. Just a couple months ago, we didn't have 8.3% inflation. Now we do, right? Now the Fed's increasing rate. The Fed's becoming way more hawkish. And we have seen the markets turn, and people are just finding it harder and harder to just pay for stuff. So I have to take that into account. That's why my assumptions are now significantly lower. Now, when it comes to the predicted share buyback, 18%, guys, that's massive. I don't think that they'll do this again. I think that they'll slow it down a little bit, but they'll still be able to buy back. So let's actually say that within the next 4 years, they'll do around 5% for the low assumption. Let's say 7% for the median, and let's go with 9% for the highest assumption. And guys, we get target share prices, and yeah, guys, they are looking good. Low assumption, it is $175.76. Insane. Median, it is $185, which is essentially $100 more than what we are at right now. And the high one is $196.41. Adjusting for debt, take a look at the cash and equivalents, and that their net debt. If they have more debt than cash, the value comes down, and if they have more cash than debt, then the value comes up. It does come down by around like $3 or so to now $172.39 for the low one. For the median, it is $182.38, and for the high one, it is $192.91. Adding a margin of safety on top of this of 5, 10, and 50%, this puts me between the range of around $146.54 to $163.78 for the low assumption. For the median, it is $155 to $173, and for the high one, it is essentially $164 to $183. Guys, the current share price is 85. What? That's crazy. That's absolutely crazy. And y'all saw the highest point that it was this year. I think it was at around like the $175 point. I think it was like $178. So yeah, guys, I mean, it's telling me based off of my assumptions that I have right here for the revenue growth, projected share buyback across all assumptions, it's a screaming buy right now. And even last time when I analyzed this, I think I got the same thing. But I was putting in a lot more revenue growth numbers than now, and it's still telling me roughly around the same. Now, a lot of people will probably look at this and just be like, the share price is 85. It will never go back up to 175. What are you saying? Now, if that's you who is just hating on this, let me just point out that that is exact opposite as to what a lot of people have been telling me as of like the past couple months. The company could never fall $100, like Shopify. That company would never fall $100, and it had already fallen like 400 like a couple months prior. So now it's like the opposite. So to all those haters who are probably thinking about that, oh my god, the share price will never be 175, understand that discounted free cash flow, it is the value of the company, not the share price of the company. The share price is dictated by the market. The market could do whatever it wants, right? If you take a look at the fundamentals, which we just did, guys, they are increasing their cash flow. They're increasing their net income. They're increasing their revenue. They're buying back shares. It's all good things, right? And basically, this is the price that you should be buying this company at, assuming you think that they'll grow at 2% to get a 10% return in the next 4 years. So if that's 10%, imagine $85.82. It's insane. So that's just essentially my assumptions. Again, like I say in every single video, please have this calculator, make your own assumptions, put in your own grades. This is not financial advice, and every investment is the present value of all future cash flow. So based off of my assumptions, I'm loving this company, 83%, and it's looking like a screaming buy. You guys may choose different, so please have this calculator, make your own assumptions. Now, I also have, guys, my book value calculator, my re-evaluation calculator, and a dividend tracking sheet for everybody to have. So please, it's all for free. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. It really does help her with the algorithm on YouTube, guys. We're almost up to 1,100 subscribers. That's insane. Hopefully this video does pretty good. Usually tech companies like these do pretty good. So, you know, I like the company. I like the company. Hopefully you guys like it too, and we get a lot of interaction. So again, just help me grow my channel. Like, subscribe, comment. It really does help. All in all, guys, when it comes to Qorvo, I don't remember what I said last time, but if I said anything different than this, then I am so terribly sorry. But this is a beautiful company. Honestly, like it's a beautiful company. You're looking at the numbers, you're like, oh, it's only in the millions of dollars, right? The castle's only in the millions of dollars. Who cares, right? As long as they're growing, at a certain rate, I don't care if they make $1. If they're in the next 4 years going to 10 times that, I don't care what it is, right? Every investment is the present value of all future cash flow. What are you willing to pay today to get that future cash flow? And by this company's standards, it's looking really good. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my music sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.